First, we had the great financial crisis. Then we had the trade issues and election issues, the pandemic, the war in Ukraine, inflation pressures, tensions in the South China Sea. Now we have a banking crisis, which is developing and evolving. And then just to spice things up a little bit, we started this week with OPEC cutting production, which is going to hike rates. All that, we still have a lot of elections coming up. We have a debt ceiling debate. And of course, the ongoing issue of should they or shouldn't they at the Fed raising rates or not. So in times like this, I get asked a lot, when's it safe to go back into the markets? So I'm going to try and answer that today. I want to just talk about three things. Globalization, which is the changing terms of trade that we're experiencing. Talk about the inflation conundrum that the Fed is facing, and then where to put money today. So let's kind of blow right through. What we saw in the last 40 years has been pretty amazing. GDP has really taken off. It's tripled. The developing markets have seen enormous changes. They were growing at fivefold the opportunities that other people saw. Billions of people have come out of poverty, but the issue is globalization didn't work for everyone and the benefits weren't shared equally. So I want to just share with you the shift that we've had over the 5 different eras that the World Bank cites for globalization. Starting in the late 1800s, we had the industrialization phase and you started to see some growth. But then we had the wars and protectionism in World War I and World War II. And you saw, global trade really slow down as a percent of global GDP. That's imports and exports. And then we saw the Bretton Woods era of the 60s and 70s. And then we moved into the liberalization stage where globalization really took off with the emerging markets and led by China. But for the last decade, we've basically flattened out. And that's the globalization phase we're in right now, where we have this really low growth period where we're looking at maybe sub 3% growth for this year. But we're in this kind of a tough period where the sins of the last decade, a decade and a half of coming back to roost. And a lot of that's around the amount of debt that we have in the system. So when you think about the next phase, the ideal scenario would be that we'd cooperate and all get along, work together to solve all the big problems that we have in the world, like climate change and inflation and world hunger and the like. But that's not practical or probable. The likely scenario is we continue along the path of global fragmentation with these political and economic blocks being set up. And as a result of that, the big opportunity for investors, we believe, is going to be the reindustrialization that's going on and the reorientation of supply chains and what it's going to mean for different parts of the world and who wins and who loses. And I think this is one of the big investment opportunities that's going to be ongoing for the next decade as we see these major shifts going on. So I think this is really the important part to think about as we end up in a world that's either going to be bifurcated or trifurcated with the democratic and autocratic nations going against each other, and then other countries playing both sides against the middle, which would be Middle Eastern nations like the Saudis, how can they get the best benefits from both the US and China, and how do they play that? I think this is going to be a very complicated global situation, but I think you're going to see very much of the slowing in global trade. It's not going to end globalization. It's going to reorient globalization into a different period. So switching gears to the inflation and getting back to the OPEC cuts and what they've done to the inflation outlook. Because of the banking crisis, we had slowing growth. We were expecting that you were going to see lending standards get tightened. We're going to see the rapid rate increase we already had, which after a decade of really zero interest rates, or actually 9 out of the last 15 years, we've had zero or negative interest rates in the world. You can't go from that to a period where you automatically in a 9-month period adjust to spiking rates up 400% and expect that the economy can adjust to that effectively. So that's a change that we think is going to be really, that's the adjustment process that everyone's struggling with right now in the global economy. And the banking crisis is a reflection of two things: the stresses in the global system, but also the tightening of financial conditions. Because as we've talked about in the past, when the Fed tightens, things get stresses and the vulnerabilities of the system are laid to bear. And that's what we saw. Further complicating the inflation issue is wages. And we have wage pressures that are continuing to persist, as we're seeing some pretty healthy wage increases coming for pilots and other union workers and other workers around the world. And at the same time, you have layoffs going on. So you have these layoffs on one side, wage pressures on the other. But when tech companies lay off people, they get hired pretty quickly because there's a shortage of labor. So we keep on spinning on this wheel, which makes it very hard for the Fed to determine which way they should go. And really making things even more complicated is everyone was expecting China's reopening from the pandemic to be a big driver of global economic activity and therefore inflation. And what's happened is China's focused on a higher quality of growth and more internal growth. So they're not going to be the engine, which means when you step back and think about all the changes going on, corporate earnings should be under some pressure, and that's going to create more divisiveness in terms of more dispersion between the haves and have-nots. Excuse me. So you can just get a look. OPEX, this is the WTI for the last 5 years, and you can see we had a big benefit for the last year of oil coming in, but it's still at a fairly elevated level, and now we're back moving up and some tightness in supply. And when you combine that with the cuts that OPEC's making, with the fact that lending is slowing to the oil producers, that's going to put some pressure on both the supply issues on that. And we think demand, while it is under pressure, is not under pressure enough to offset what these cuts are going to do. So we expect prices will still tend to trend up. They won't necessarily run away as much as we thought in the past. We have this continuing push of the inflation, the tightening that's been going on, offsetting against the 15 years of easy money conditions. And that's this legacy liquidity is what's being called, that's in the system, going against the inflationary pressures. And that tension is what's confounding people, why you're seeing the economy hold up better than it should be in the face of the problems we've been facing in terms of inflationary pressures and debt pressures and the like. It's because there's so much support been put into the system the last couple of years that's offsetting the near-term pressures that we're getting from the higher inflation. So we have this battle that I've talked about of legacy liquidity versus a sharp policy reversal. And this chart, again, I showed this last week, but it shows you just how sharp and abrupt the tightening was this time. So this is a scale and magnitude that we're expecting a system that was 15 years in the making to adjust into in a 9 to 12 month period. That's not how the economy works. This is why things have been breaking in the global system when you have this type of a change. And you can see this compared to other tightening cycles. It's much more aggressive and it's much steeper and shorter in its time frame. And that is actually really distorting things. And you can see that the other element of what's impacting the inflation fight is now the problem in the banks. And this is the Keefe Bretton Woods Bank Index. And you can see the sharp drop from March 10th that we saw here. This means there's more stress in the system. While we think the central banks and Treasury have done a nice job of easing some of the pressures, we don't think we're out of the woods yet here. We think this is going to be an ongoing issue with some slow burn going through the system. I'm anxious to read Jamie Dimon's letter because I think he's got a very good handle on some of the stresses. And just keep in mind, community banks and smaller regional banks are big lenders in the commercial real estate area, which is potentially another shoe to drop coming. And that's a big fear in the system. So you have these negatives going on one hand and some positives going on the other that are really making it very difficult for Fed policy to be clear. And the lag effect of Fed policy with all the legacy liquidity in the system, fighting the near-term pressures that we're seeing with the banking situation and other financial stresses. It really makes it very complicated, which is why I think Powell is taking a very balanced approach to how he's going after it, and also why the Fed is very confident that they need to fight inflation and get that wrestled down. They have to see what evolves with the banking system. They hope that the changes they made will tighten and ease some of the pressures that are going on in the system and slow the runs. But at the same time, they do want to slow the economy down. And ironically, the banking crisis may have actually done the Fed's job for them in terms of fighting inflation. And here's another example of it, the banking crisis doing the Fed's job. This is the bank's willingness to lend. And as you can see, this is into negative numbers. And I believe this chart is as of February, so it's not even counting in the banking crisis. So what happens next? I suspect that a lot will depend for the Fed on whether the crisis with the banks continues to evolve in a slow pace that's not leading them to be concerned about the liquidity issues and have to change course. If they don't have to change course, they are closer to one more hike, maybe two, or a pause. But if the banking crisis goes on, every time there's been a financial crisis in a tightening period, the Fed has either cut rates or pause to stop the crisis. I think this time would likely be a pause. I don't think they're in that mode just yet. I think they're in a wait and see mode. But clearly, the consumer is in better shape than they were in the past, but consumer spending is going to slow. Corporate revenues, therefore, will slow, which will squeeze some of the earnings because they won't be able to pass on price increases as easily as they had, which you're starting to see this come through. And one of the reasons for the layoffs is actually a cost squeeze that they're having, where labor costs as a percentage of revenues are creeping up to levels that will force them to have more layoffs going on, which will push them into other areas to invest, mainly investing in productivity. So against that backdrop, you want to invest where the government and corporations are spending. That takes you back to the Inflation Reduction Act, the CHIPS Act, and the National Defense Authorization Act. And capital is going to flow to the beneficiaries of the electrification, digitalization, national security, healthcare, and quality that companies, not ones that are scratching for money in this type of environment. So where we're putting money is in the industrials and materials sector, telecommunications. Interestingly, the FANG stocks, are the big 8 stocks in the market, since January 5th, I believe, have had their combined market caps increase by almost $3 trillion, and will account for about, if the S&P is up 14% from its lows in October, they've accounted for 3% of that move themselves. So 8 stocks accounted for the bulk of it. So it's a very, you have to be careful there. Everyone was writing the FANGs off at the beginning of the year, and yet they're big drivers in the market. So we think that the cloud area and the semiconductor area are still very positive plays. Productivity has to come back into the markets as a bigger push. The energy transition is going to prove to be very difficult, so you want to be on both sides of that. Healthcare continues to be a great opportunity. Innovation is going to be essential, and balance sheets are going to matter, and so does liquidity in this environment. Mark, I'd also just say, I think what's going on in China with the breakup of Alibaba and what they're doing there is a very interesting take, and gives you a sense of where you'd want to invest in China is invest with the Chinese 5-year strategic plan, and understand that go with the government. It's like, don't fight the Fed. I wouldn't fight the Chinese government either, but I think it is moving back to some really more interesting opportunities there. And if you think Alibaba is going to be split up into, say, 6 companies, each one of them is going to be a market leader in its own space. And you're creating 6 national champions now with a different government backing. I think the dynamics in China are changing. Not going to be easy for outside money, but certainly clearer where you want to put your money there, I think. So I'm going to stop there and open it up for questions or comments.
Thanks again, Stephen.
I have a question, Stephen. Do you see credit unions at the same level of risk as the small banks and regional banks?
I haven't looked into their assets and liabilities, so I can't answer that.
Is there a reason why
Stephen.
you asked that? Was there a reason why you asked that question, Jeanette?
Yeah, I'm just curious because it seems that traditionally they have been friendlier and yet more conservative on lending and issues like that, where the larger banks have been less constrained or less, reserved. And so I would imagine that they have a base that's more loyal and less disturbed by the current economic conditions. So just curiosity.
I think they would probably be less prone to runs for the reasons you just mentioned, but I don't know what their assets or liabilities look like.
Yeah, I heard a comment. Really, it's really shame on the boards. For the regulators have to look up to this, but shame on the boards for some of them. Andrew?
Yeah, thanks, Stephen. It was great meeting you in New York, and I thought a couple minutes there asking, and you kind of highlighted the steel industries in the U.S. and the combined market cap. I'd love a little more 2 cents on that. I thought that was an interesting perspective.
So the steel industry, the top 5 U.S. steel makers have a combined market cap of about $60 billion, $70 billion. They are arguably essential for every aspect of the reindustrialization of corporate America. The CHIPS Act is essential for it. So if you think about, and the clean energy transition all require massive amounts of steel. And yet a lot of the steel is produced in China globally, and all the issues that we're looking at now with the IRA, the CHIPS and Science Act, the National Defense Authorization, the criteria they're putting around accessing those funds will have you sourcing more from the U.S. So that's going to favor not only the steel makers, it's going to favor companies like MP on the rare earth side. It's going to favor sourcing copper and all the materials that we're looking at. So we think that's an important area. If you think about the fabs we're building for the chip industry and look at what Intel's doing and TSMC and Samsung, those fabs are going to require probably 2 or 3 times the rebar that a normal building would have, because the fabs can't have vibrations in them. And otherwise you're going to have problems with the etching of the making of the chips. So it's a very steel intensive transition we're going through. Think about wind towers and the amount of steel in a wind tower, and you just keep going through. The clean energy transition is anything but essential. And so we're trying to own the essential elements that are going to be required to make that transition, and they're in scarce demand.
Do you think composites are a fair alternative to steel, Stephen? Are you seeing that in investments?
I leave that to the smart people who are working on all the new innovations, but I think it's going to take a while. And I think the transition is going on now, and we need the stuff now. And I think that's a ways off. So I think what we're looking at is over the next couple of years, you can have better opportunities. And we think this gets to investing in the real economy right now, which is where you want to be. Mark?
Yeah, Henry, you got your hand up?
I do. Hi, thanks, Mark. Stephen, with respect to your comment about Alibaba's breakup, right? So it's kind of interesting. I've been thinking about this topic for the longest time. So when you look at historically, you have conglomerates, traditional conglomerates. The playbook has always been break them up because the sum of its part is greater than its whole. Now, that's the traditional conglomerates. About 10 years ago, with all the apps, the new economy, right? So the playbook is, you know what, let's keep everything within the app or the ecosystem, right? Like all the different businesses, like Alibaba built, all the businesses Tencent built, all the businesses Amazon built, so many more examples. So that was the playbook for the last 10 years. All of a sudden now, you got, whether it's political or business related, you got the breakups of this sort of tech ecosystem, keeping everything in-house, but break them apart. Do you think this is the new trend for all the tech breakups going forward? Not just in China, such as Alibaba, do you think this is the new playbook for Amazon, for Tencent, for all these sort of tech conglomerates to be unlocking their value rather than keeping in the same ecosystem? If you understand my question.
Yeah, I do. I think the Chinese one is very different because of the invisible hand and the visible hand of China getting involved in the companies. But I also think it gets into where China wants to take their corporate, their economy in general, and how they think about it very differently than the rest of the world. But they're going to end up with 6 leading companies instead of 1. They keep doing that. That actually bolsters up their capital markets some, which is part of what they're trying to do as well. And it gives them better control over each of them. And I think they were really worried about individual power.
Right,
So
but
I think that's the issue
question
there.
is, do you think this playbook would apply to other tech conglomerates? Like I say, Amazon, I could grab so many more examples.
So I think the government, I think in the US, I think the US government's going to try and play a role in breaking them up more than the companies themselves. I think the companies here I think we'll see a lot of divestments of smaller businesses in the US. I think it's coming in the communications sector. I think what Disney is looking at right now with Hulu and Comcast could trigger a whole wave of breakups there. But I think you won't see the same thing in the US tech sector unless it's brought about by the government.
Terrific. Thank you, Stephen. Thank you, Mark.
Joe? Joe, you have to come on camera if you're going to talk, though.
All right. Hey, guys. There we are. So, Stephen, curious, there's a lot of talk out there right now about the dollar and, the pressure that it's under, given, you've got China kind of playing a larger global role and kind of coordinating with creating these, like, as you called, these economic blocks where they're coordinating with Russia, they're coordinating with Iran and Saudi Arabia and how to conduct trade in the yuan. Is the dollar under pressure? I've also seen, just year to date, gold has done phenomenally well. I mean, what are your thoughts there in terms of, the dollar's pressure, and also what does that mean for the U.S. as kind of the global reserve currency?
I think the U.S. will be the reserve currency for a long time. I think it's very hard for an autocratic nation to ever get reserve currency status. So I think that eliminates, under the current regime, China from ever getting there. But aren't they
working to sorry to cut you off? Aren't they working to create like a new sort of currency, like the BRIC currency?
Without question, there will be pressures to reduce the U.S. power. That's China's whole goal right now.
Right.
But it's easier said than done. And you see that in times of crisis. We attract a lot of capital. Rates come down whenever there's a crisis, which means that the reserve currency status holds. But in the short term, we could have some dollar weakness only because if we're peaking in rates and the ECB still has further to go, that could lead to less dollar strength in the near term. But I don't worry about the dollar currency status for some time. Further out, if we ever got into a regime where there's central bank digital currencies that become a much bigger part of the ecosystem, then you would have a different kind of a setup. But I think we're ways off from that to be a concern.
All right. Thank you.
Hey, Joe, do you mind we haven't talked for a while about crypto. How are you seeing the crypto market?
I mean, it's done incredibly well through this banking crisis. And I think it's pretty interesting just because when people were kind of, during this Silicon Valley Bank situation, when people were looking for a place to move capital, the interesting thing about crypto is this was like what it was made for, right? It's like you kind of take the capital and the money into the banking, the system into your own hands. And, I think it's held up really well in the face of that weakness when it comes to, the broader markets and the banking sector in general. So I think it's been, it's kind of solidified its use case. And, Bitcoin itself was made like back in 09, 08, 09 during the last crisis. And so you kind of see it actually holding up really well. So I definitely something people are focused on.
Would you be interested in sort of co-leading a little event that might sort of shed light on that? It could be an hour long. You don't have to take it on your shoulders, but just
happy to participate. And then obviously I've worked with the guys who are over at Dual Worlds who run like sort of a fund in that space. So happy to kind of have them involved as necessary or whatever, Mark. So drop me a note. Give me a shot.
Let's compare notes. Adam, but before you talk, we have a new person, so that new people get a little extra jump on you. Zachary, if you don't mind letting him go first.
Yeah, my question was for...
And Zachary, just reintroduce yourself if you don't mind, just new group here.
Yeah. So my name's Zachary Fettel. not a big fish or anything. I've just been investing with my family since I was a teenager. And brought on by, or referred to you guys by Andrew Maroli. Yeah, my question for Stephen is, kind of on the macro level, like in terms of a reserve currency and the fluctuation between reserve currencies, what role do gold reserves play in that? Because as of right now, we're still more than double from the runner-up, which is Germany, in terms of tons of gold in reserves. And although our currency is not, backed by gold anymore, at the end of the day, like, does it matter? Or
Not really. Not at this
Okay.
time. It doesn't matter as much. When we went off the gold standard, it kind of mattered a lot less at that point. There's this stock of currency is so great now. It's not the same. So
Okay.
But Stephen, there was talk actually about with China and Russia and Iran developing a digital currency that's actually backed by gold. Have you seen anything on that? Have you heard anything on that?
they're all looking at ways to get around to weaken the dollar and move off the dollar. But it's much easier said than done because commodities trade in dollars right now. So the way they're doing it, Joe, is China's been very aggressive setting up swap agreements with trading partners so that allow them to avoid having to get caught in dollar squeezes. And it's designed to move more currency away from the dollar, but it's harder to do. It's easier to do than to say that it is to do. It's not easy to make that transition. And do you want to, if as an investor, Joe, do you have confidence giving your money to Putin? And because that's the backing of the currency is, maybe you get Putin and President Xi and maybe Kim Il-jung, and they can come up with a currency for you.
Totally. Yeah,
Right.
I don't see myself moving in that direction, but I do see, potentially moving into a current, gold itself, because if those large nations are going to start backing their own currencies with gold, I assume that gold's already up like 20% this year. I would imagine it could continue to run if those things actually take shape. I don't know though.
Yeah, gold it'll be interesting because gold always has a trouble getting over 2,000. So gold's a tough investment. So people can, figure out how to play that on their own. I wouldn't use the currency. If they go for a currency backing, it won't matter. But when people move off it, England sold all their gold back in 2002. That was probably the time you should be buying, so look for the people selling, not buying.
Well, let's keep it going. Adam, thanks for your patience.
Stephen, regarding Alibaba and the breakup of Alibaba, that is more a breakup driven by politics as opposed to economics. Is that not the case? That's one question.
Absolutely, to start, but I think there are economics behind it that they think they can do better as a country having those 6 individual businesses. So I do think there is an economic element to it, not just political for them. They want to dominate in those areas, and they think maybe they can dominate them better separate than together.
As a country, as opposed to in the private sector.
Right.
Okay.
So Adam, while you're here, let's do a refresh on on Russia, Ukraine at some point. Michael Hammer.
Yeah, Mark, on that guy getting blown up, the blogger getting blown up was actually pretty scary.
Well, it's scary. It's scary for the Russians internally, because as someone, I don't remember who wrote this, but it was, I think the Ukrainians described it as the spiders eating each other in a jar, which is the case. That really seems to be what's going on.
Michael.
So Michael Hammer.
Stephen, so people talk about the high dollar, weakening dollar, but when we look at Russia, most of a larger proportion of their trade is with Europe, and so that currency relationship seems to be more important, setting aside the impacts of sanctions. So is it really Russia and China and Iran, or is this broken apart? China has a much more global trade relationship. Iran has a much smaller trade relationship with most of the world, and Russia has been primarily with Europe.
Yeah, but they each are trying to do the same thing, though. That's the common element, is they want to weaken the U.S. in each of those cases. So their motivation for a common currency is that it's to move the world away from the dollar, closer to them. And they're really going after the states that have trade relations. So Africa, South America, that's really what they're trying to get. They're not going to try and change the minds of Europeans or Japanese or Australians or the UK. They're not going to get them to, oh yeah, let me throw my money into those currencies. But the rest of the world, they are trying to where the biggest population growth is coming from in the future. And that's really what they're trying to, I think, play.
Fair enough.
I think the dollar is way overdone, though, for all the discussions on it. I think it's very difficult to push around the dollar in a meaningful way unless the U.S. screws itself up, which it's quite capable of doing. Don't get me wrong, but it's not as easy for others to push it around.
Other questions? Anybody born in April that has a question?
I have a question. Is Eddie or anyone from Europe, anyone worried about the change in cut in production and what it does to energy and the budgets of governments right now in Europe? So subsidies have been pretty high and they got the benefit of the winter. Just wondering what happens next.
I haven't followed it lately, so I can't really answer, but that makes sense.
Perhaps one comment going back here, more generic, if that's all right, is when we're seeing some of the cut in productions and the removal of subsidies, two things we anticipate is it could act as a feeder for demand inflation later. Because obviously if you're drawing down stocks or drawing down supply, demand starts to come back up later. And then of course, there's no supply left and you have price inflation. So we think there's a corollary saying that this hits price inflation at a later stage. Of course, then hitting the inflation figures again.
And then the other worry in Europe right now is the commercial real estate loans, and how does that market play out, not only in Europe, but in the US as well. But growing focus into that area is the next place of vulnerability.
I think the short answer is messy. Really, you saw China move on some of their stuff a few months back, where they started to supply support to the industry and cover some of the indebtedness that's happening over there right now. We don't have that kind of support here in the UK. So there's going to be a pressure on properties. Of course, then you're going to get property being sold at discounts. It gets a little messy.
So, Michael, since Bill hasn't had a question yet, Bill, you want to go for it?
Just a quick chit shot and fun fact going back to the dollar. Googling it quickly, the Fed estimates between 1999 and 2019, dollar accounted for 96% of trade invoicing in the Americas. No surprise. 74% in Asia Pacific region and 79% in the rest of the world. So just reinforcing your point. So much talk, but realistically, it's going to be so difficult. And I think also the interest rate differentials right now are such that the dollar is more attractive on that basis. It's a little less so, but that's still gonna keep it somewhat strong.
The depth of the capital markets system here is unparalleled too, and that's hard for people to put in perspective. But relative to China, Europe and other areas. It's a very different dynamic and so much deeper and bigger. So I think that plays into it as well.
Michael, back to you.
Okay, Stephen, you raised the impact of oil prices and whatnot. Looking at the U.S., first, I follow natural gas much more closely than oil, but there's been a divergence. So oil's been going up. Natural gas, May, which is the front month, is about 209, which is pretty low. What incentives could the U.S. government give domestic producers to increase production? And I know the latest round of offshore leases, they increased the royalty rate from 12% to over 18%. So what could they do?
And they could, if we really want to increase production, they could do a whole slew of things. Accelerate the permitting process, make approvals much easier, take away all the obstacles we put in place over the last, 40 years from producing at a high rate. So I think there's a number of things. I don't think the political will is there to do that right now. So I don't think they want to see a rapid ramp up of production of oil or gas as a government right now.
The other issue is, even if the government does things, investors in the oil patch are basically saying, nope, we want returns, not CapEx investment.
Yeah, and that's the other element. Not only is there the investor side of it, but the lender side of it is also going to be an even bigger problem than it was before, because banks are going to be pulling in the lending considerably and lending to areas that are in the bullseye of ESG. As we've talked about, you might get half the states that are favor of that and half the states are against it. So you're not going to get the full support of it. So I think you're not going to, I think there's a lot of headwinds for getting production up in the US that'll keep prices higher than they've been. I'm not sure on the natural gas side, but oil definitely should be skewing at these levels that are slightly higher for a while.
Wasn't there a story about the gas production being curtailed back by a couple of gas specialists in the paper today?
I missed that.
Say it again, Duncan.
I'm sorry, I'm driving a car. There was some news in the media today about two of the large specialist gas producers. So, there's oil producers that get natural gas as a sort of a byproduct or an accompanying product, but then there's also pure gas producers. And they said that the pure gas producers were actually looking at ways to curtail their production. And then they had numbers that were speaking about the production of gas and the demand for gas, and the demand still seems a lot higher than the production. So I'm trying to figure out why that market is so weak. I'd love to, if anybody's got any insight into that. I mean, you kind of touched on it. Oil is screaming, and it's always all about oil. Gas is the cleaner energy. And I don't feel like people really understand how the pricing dynamics work, including me.
I do think there's one thing that people are a little worried about, Duncan, which is the overbuilding of storage facilities in Europe for natural gas. There's a concern that they've gone too far the other way or might be overbuilding, so that there might be a little less of a squeeze there is the thought, but haven't really confirmed that. But that is discussions around the natural gas.
Michael Hammer, you want to speak to that since it's in your backyard there?
Yeah. So the reason that they're looking to curtail production is, like I mentioned earlier, the price at Henry Hub of natural gas is really low. And so it becomes a question of if you're investing in production, or if you want prices higher, curtailing production, that's what you do. You want to get those prices higher to where it's profitable. And then the second thing is natural gas is an imperfect substitute for oil, right? So like for transportation, you can't just easily switch from vehicles that consume gasoline from oil to natural gas. Now there's commercial fleets that utilize natural gas, but that's a much smaller segment of the market. So I think what we're going to see, given the low prices, they will curtail production. How much is a question mark, but you're also going to see increased volatility, right? We had a warm winter, so stocks in inventory storage are high, but they only go so far if you have I don't want to call it a black swan event, but something that causes a spike in prices.
How about our export capacity shifting? Are we building any more export capacity?
Yeah, so there's some more terminals coming online. They're not as big as some of the ones that are out there. But again, because it was a warm winter in Europe, their storage is looking pretty good. And most of that export capacity is long-term contracts. So even when it spiked to $9 plus, that doesn't mean that the folks who had contracts for LNG were actually paying that.